ladies and gentlemen of the crypto space. We're live on a Monday, April 3rd at 11:35 a.m. My goal for myself, my goal for our little community, my goal for a larger community on social media such as Twitter is to present the rational case for what is overwhelmingly an irrational environment, or at least as it's consumed by the vast majority. And I have asserted for years at this point that there is a rational perspective to be had about all this stuff that is going on. And we need to peer through the hyperbole, peer through the exuberance, peer through the naive dream of that financial freedom is easy and quick. If anything, the last couple of years has proven that the tortoise versus hare, the longer approach, the tried, tested methodology of due diligence, patience, and calculation pays off over time. So, how do you express prudence and care and restraint in an environment that is extremely volatile? And we're not even talking about crypto anymore. I mean, the bond market in 2022 was ridiculously volatile at historic levels. There is nothing that I'm expecting into the future that will be decreasingly volatile. I expect increasing volatility. Obviously, we're in a period, a transitory period of low volatility. The last couple of maybe a week, 2 weeks, but the volatility will return. They stabilize the volatility for this transitory period. And you know what kind of event or sequence of events would have played out if the several banks literally would have been bankrupt, and that cascade effect of capital destruction would have played out. So that is the role. That's the role that they have been fulfilling, aside from whatever their stated policy is. Their role is volatility suppression, normal market operations, effective liquidity conditions, so shit doesn't fall apart. And I think now more than ever, there is absolutely no return to normal without the powers that be somehow accepting that chaos would occur, and they're okay with that, but that's politically destructive and that makes no sense. So that is irrational. It's rational to observe what they've done thus far is suppress volatility such that the system continues. So if the system continues, and that's their mandate, to allow the system to continue to function and chaos not to occur, then we can expect we have an opportunity to digest the market behavior, equities, precious metals, uh, 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 natural resources, as well as digital assets for opportunity. Redefine expectations in this bear market to identify opportunity, because if the expectation in a bear market should not be significant outperformance. You can have outperformance. It's going to be very isolated and concentrated to select assets. There's less capital around, but this is a perfect period of time to see what will outperform during increasingly liquid conditions. The stuff that does well in bear market conditions, the stuff that survives, has a different place in people's minds during better times. So I mentioned on Twitter, we'll talk about the obvious culprits, the Bitcoin, the Curve Finance, the Balancer, and LPing. And we'll try, let's see how well I could stick to the script today, and we'll tackle them one at a time. Let me just state one more time for the record. I'm Noah, Captain Rational. I'm 40 years old, and I'm responsible for myself and my family, for our financial obligations. We need to remain solvent. We need to finance our monthly expenses. We need to plan for the future. And to do that, we must survive. I and my family. And the stories that I tell you is my journey that I am doing for myself to that hopefully these stories make it better. It's not going to be easier, but at least help folks that listen to my stories do better and more likely to survive. So Bitcoin, we'll start off simple. We'll start off, I'm trying to talk more and more to the general public now. I could start that thought with, unfortunately, the general public will never listen to me. The general public does not invest. The vast majority don't have $1,000 in their bank account. The vast majority live paycheck to paycheck. The vast majority cannot entertain these types of sophisticated capital management conversation. And that's a result of many things. And I'm not going to provide financial advice in that regard. It gets contentious the second you say spend less than you make. And that is not what I want to do. I want to help folks that you can only help folks that can be helped, that are in a position to be helped, and also that want to be helped to make better decisions. And that's a different type of conversation. Like how do you fix someone's balance sheet? How do you fix their budget? How do you tell someone to sell their car and get a $100 a month used Honda Civic from 2005? Come on, that's not a conversation that I want to start. Anyway, so let's just say Bitcoin. Someone is trying to jump over the ledge and think about an allocation of capital. Why? What's the purpose? What's the meaning? What's the significance? What role does it play in owning something? The vast majority think in terms of the stock market. I buy something, I sell it for a higher price, and you need to understand why something goes up in price is that other people are buying it after you, and you are able to sell it, taking some of their money. That's PVP. Player versus player, that's capital gains. And that is a sophisticated strategy that requires technical analysis, this requires social media investigation to understand the climate, the state of a market, that requires due diligence to assess demand for a particular asset. In this case, Bitcoin has a very large narrative now from a global perspective, and Bitcoin maximalists will often talk in terms of reserve currencies and potential currencies, adopting it as a payment system and Lightning Network integration. But what is the intent of a purchase? Is the intent of a purchase to finance something in the short term, is to own something, but what is the expectation, the time horizon of that ownership? Now, obviously, that narrative works. Uh, um, DCA, dollar cost average, you own little bits here and there, and then maybe will become something in the future. You get a 10x on Bitcoin in 100,000 years by 2030. You turn $100 into $1,000. You turn $1,000 into $10,000. Bear in mind that in itself requires a restraint of expectation. There's no destination wealth. There's no destination riches with that methodology. Bitcoin is no longer an opportunity to significantly outperform the market. It will significantly outperform things like NASDAQ. You're not going to get a 10x on NASDAQ. It'll significantly outperform the S&P. Raoul Pal talks about this very nicely, that the S&P generally tracks currency expansion, at least from a domestic U.S. perspective, and NASDAQ is a multiple of that, and then crypto is a multiple of NASDAQ, and then and crypto, him saying that it's predominantly Bitcoin, then Ethereum is a multiple of Bitcoin, and then altcoins are a multiple of Ethereum. So the outperformance and the path to significant gains really is outside the scope of Bitcoin. And that's from a gains perspective, which means you have to have a predatorial mentality to purchase, deal with volatility, assess when other people are buying, identify a sell point, an exit price. It is a requirement to be methodical with how you engage with that type of strategy. And this is every cycle, what we see time and time again. Hodl to the moon. Oh, God. And that is a way to lose everything. That is the path where other people capitalize on you. Bitcoin is not the opportunity people think it is. It's the same for most stocks. It is not an enterprise. There is no cash flow. The notion of inflation protection is awkward, to say the least, and that is something that is unfortunate. It's a false narrative that people are buying into, particularly in the context of expectations. The purpose of a purchase. What is it trying to do? In what time horizon? So I guess a good statement is you need to define these things. It is imperative to define your behavior, to have a rigorous methodology, to engage with calculation. I am going to do this, this, and this because of this, this, and this. It's going to have this expected result. And this is what I've talked about over the last maybe 2 years is invalidation of a narrative. If you have an expectation in a particular period of time and things don't look like it's heading in the right direction or the desired direction, it's likely your expectation, your narrative is invalidated, in which case the rational thing to do is exit. And that's okay, and that's hard. It's hard to watch something that you have probably still a valid and good narrative about be invalidated from an investment perspective. Like, look, the narrative around Uniswap is wonderful. It's immutable. It's not, it cannot be turned off, barring the electricity being turned off or a disruption in the functionality of the Ethereum network. That's an extraordinary narrative, but from an investment standpoint, I've stated very explicitly many times, and I will continue to say so, Uni is a completely uninvestable asset. The same thing with 1inch, the same thing with ARB. It is completely uninvestable. An investment, fine. You can say that capital gain strategy, player versus player, bringing out your predatorial instincts is an investment. I don't like to think of those things as an investment. Those are transitory capital allocations where you're trying to extract capital from people that are less experienced than you. Buy first, then they buy, then you take some of their money. So that's not an investment. That is an engagement. That is a predatorial engagement. Let's pop it over to the main screen as I talk. I got the DXY up. So we've invalidated the narrative that most people use for investing in Bitcoin. They have the wrong expectations. They have the wrong time horizon. They have the wrong position sizes. They have no exit strategy. They have no engagement strategy. Hodl to the moon. When? When do you sell? Why do you sell? What's the purpose? The purpose, you can't just believe in things. You can't just believe in a future of hope. You need to have a plan. Always be rigorous with your thoughts. They need to be uh, uh, granular. Every thought you have, you should be able to state several things about the thought. Break things down. Okay, so we talked about PVP, capital gains, time horizon, expectations. We started with Bitcoin because that is the first thing that comes to everyone's mind. Now, there's a different narrative with Ethereum, and there's a different dynamic. But that ultimately maybe reduces to just a multiple on top of Bitcoin. And all of that is dependent on liquidity conditions and ultimately exit strategy. So in most regards, the same rules apply to Ethereum. I don't see any reason to distinguish one or the other with regard to an engagement perspective. Sure, different narrative, what they do, what their purpose is, but you buy something and the only capacity is to sell something, it's the same if use to you. Clearly, staking is involved with Ethereum. So there is the notion of duration, there is the notion of returns, but the size of the returns for the vast majority of human beings on the planet is not effective to achieve expectations. Sure, 8%, 12% on Frax. If you got $1 million or more, all right, if you got $1 million and you get an 8%, you get 80 grand a year. Don't forget the capital gains tax, or well, the income tax, because that's income with 120 grand a year with F, FXS ETH. So that is considerable. But from a position size perspective, be disappointed. You just invalidated your investment thesis. It's uninvestable, and that's okay. It's the most important thing in the world to be able to invalidate potential investments. You have just simplified the crap out of your job, uh, and it's an emotional thing. I want to own that. I wish I could capitalize on that. I wish, I hope, but you just invalidated it. You will not be able to achieve your expected result because you don't have enough money. And that fucking sucks. And that is frustrating. Is that about equality? Is that about opportunity? Is that about, the rich get richer? Yes, that's exactly it. The rich get richer because they have a capacity to expose themselves to opportunities that other people cannot because they don't have adequate position size. But if you expose yourself there, you're not going to meet your expectations. I mean, maybe your expectation is to take $1,000 and make $80 a year. So as long as your expectation, uh, you, you know the destination, you can meet your expectation. If you buy $1,000 worth of FXS ETH and you stake it, you get 12%. You get $120 a year. Okay. Or whatever the rate is. Last time I checked, it was above 10%. And I was like, whoa, that's pretty interesting. So 10%, you get $100 a year. But when it's $100 a year, you get $10 a month. All right, fine. You could buy one egg sandwich a month. So if that's what floats your boat, if that's your expectation, you'll be able to meet your expectation. Don't set unachievable expectation and validate investments as viable. So curve and balancer are what I would argue the most interesting opportunities in all of crypto. And I invalidate stuff on the L2s like the Velodrome and the Camelot that's catchy and the other stuff that's going on in Arbitrum and even synthetics on Optimism um, and GMX. I invalidate them for myself. I don't have enough size. I don't like the liquidity conditions on the L2s compared to mainnet. I don't see the immediate future where the L2s surmount mainnet with regard to total liquidity. When I say total liquidity, yes, we are looking at stablecoins. You are not looking at TVL, which is meaningless. You want to look at the stables chart on DeFi Llama to assess the amount of liquidity on a particular chain. The value is irrelevant. Currency units are all that matters. Your job is to acquire currency units, which is income, which is a bank account, which is the same as a paycheck, which you can use to buy food and pay bills. This game is scored in dollars, and there's not much difference between a dollar and a dollar liability, and we're dealing with dollar liabilities, obviously, in the crypto markets. So, From a liquidity standpoint, as much as there's significant outperformance on the L2s, and I will get to that when I talk about LPing, um, I see less investment opportunity. So notice I said investment. LP is not necessarily an investment as I would describe it. That's more of an engagement or an activity, and it's predatorial in regards. And there's a lot of conditions that I am defining that restrict my capacity to take advantage of probably the vast majority of LP opportunities, primarily constrained by position size. So mainnet is got the vast majority of liquidity by far by far $72 billion worth of dollar liabilities that you are chasing, trying to get a piece of $72 billion. On Arbitrum, wow, up to 2 bill. I mean, come on, you're talking about a 31x. Arbitrum needs to go 36, needs to go 36 times more liquidity to keep up with Ethereum mainnet. 36 times. So, okay, you know, great, there's opportunity there, but the amount of liquidity is a tremendously lower amount of liquidity. So that's the deal in my mind. Polygon 1.54. So Arbitrum surpassed Polygon. Optimism 672, a little stagnant. Phantom has just been off the radar, probably for it. Yep, for it changed. Solana 1.52. Solana has significant enterprise potential. That doesn't mean much in the context of what we're talking about with regard to opportunity, but Solana is still on my radar, especially with regard to Hero Network. Um, so mainnet, curve, and balancer are basically the established currency recycling systems. I don't want to go too deep. Obviously, we talk about the currency recyclers a lot. But something I noted this morning is interesting. You want, and I wish I could chart this, and I may try to, is total capex per voting cycle versus price point of the voting asset. And I expect to see more capex deployed. Like when capex was at like 17 mil every 2 week cycle, CVX was a much higher price. So basically, third parties are financing buy pressure on the voting assets. Why do people buy the voting asset when there's more money biweekly or voting cycle? Um, People want exposure to that income. I mean, that's pretty obvious. So third parties are financing buy pressure, and sell pressure is organic because sell pressure is how you capitalize. That's how the LPs capitalize. That's how you capitalize, depending on the source of the third party financing. So that is the reduction of how to look at these currency recycling regimes. The capex is the numerator, and the denominator is the spot price. And I expect as capex increases, spot price increases as well. And we've seen that. So I expect that behavior to continue. Why? Because third parties over time need to finance their liquidity conditions. If they want to remain existing as an enterprise, if they want to remain in existence or even start an enterprise, without liquidity, you don't have a digital enterprise. So in order to have liquidity, so your enterprise is actually functional and in a position to potentially survive, you need to acquire capital. If you can acquire the capital from a third-party source, venture capital, or you acquire the capital on chain with regard to LP revenue, protocol, and liquidity, great, groovy. Maybe you acquire capital like GMX and transaction fees, what have you. Whatever the source of the capital is, that capital being used to finance liquidity conditions or liquidity available for your enterprise, that contributes to the overall strength of the currency recycler regime. So third parties are going and are establishing these currency recyclers as critical infrastructure. They're anointing them as a mechanism for themselves to survive. So therefore, indirectly, are ensuring the survival of the currency recycler. So that those are the protocols that I find most interesting in all of crypto because everything else will build on them as infrastructure. Why? In the future, people look to the past to see what has worked. And what has worked is these systems are using the recyclers to survive. What happens in 5 years when you have 100 times more enterprise that want to use the systems that have been created, that have shown themselves to be infrastructure, that have proven themselves trustworthy and reliable, that have empirical data points to show specific results, they get consumed, they get used. The capital flows from venture capital to on-chain revenues, and they will be financing their liquidity conditions. So, I won't digress, but the distinction between like base layer curve balancer versus convex aura versus all the derivatives of all the derivatives of convex and curve and the concentrator and the llama, the union, the compounders. Oh, and the list goes on at this point. But guess what? All of those protocols do. They depend on the base layer. They are a product of the base layer. Therefore, for them to continue to exist, the base layer needs to continue to exist. So all of them are supporting the continued existence of the base layer infrastructure, and that's what's so fascinating. I got two comments. I'm probably gonna let's do the comments before I talk about LPs, and I'll try and fold it all together. I know you guys have stuff on your mind. So let's just cover one more thing. Mainnet's my focus. Liquidity, follow the liquidity. Capital flows from underperformance to outperformance. And this goes from outside of this emerging market to inside of this emerging market, and also within this emerging market to the other child emerging markets, the L2s, all emerging markets. And capital is flowing everywhere. But capital flows to where capital is most concentrated. If you see a crowd at a conference, you're like, what the hell's going on over there? Maybe something interesting's being talked about. So this is human nature. Most of what I talk about is just observations of how humans behave. If something is going up, it's up 5x. Doesn't that attract more people to buy it? This is what happens every couple of years with Doge and bullshit tokens that have no value. It's up. Look at this, the Hex narrative. It's up 11,000%. Is that a good investment? It's already up. I don't want some shit that's already up. I want some shit. I want to be smart enough to see something before it's up, not after it's up. So past performance means jack shit for future expectations or future performance. So expectations are completely wrong. Um, so mainnet. What's the market? What's the composition of mainnet? Uniswap has the vast majority of liquidity and volume. No, it doesn't have the vast majority of liquidity. If you go over to DeFi and you check out Uniswap versus Curve, Curve has $4.62 billion worth of liquidity, and Uniswap has $3.96 billion worth of liquidity. Curve is by far the most liquidity for a DEX, for an AMM in all crypto markets. L1, L2, Curve is the kingpin. The composition of liquidity, the composition of volume is meaningful. The demographic, the composition of the users of a particular system is meaningful. What you're targeting. Uniswap is uninvestable as a token. There's no value. It does nothing for you. PvP, capital gains, sure, do whatever the hell you want to do, but be smart, be rational. So who uses Uniswap? Who the hell uses Uniswap in a world where you have a meta DEX aggregator? I mean, this thing aggregates aggregators. Paraswap, Maka, 1inch, Kaiv. It's literally an aggregator of aggregators. You literally get each aggregator is designed to get you the best price. And this is giving you the best price of the aggregators. This is probably the holy grail of all of DeFi right now with regard to getting the best exchange rate. Now, obviously, it gets marginal, um, 7.07 versus 7.09. You're getting down to the fractions of a percent difference. But the point is, this is the best of the best. So who in their right mind goes to Uniswap? And note that you never ever see Uniswap here. You never see Uniswap here, ever. So I find that quite interesting. But Uniswap has the most volume. So let's go over here. By far, like multiples more volume. So who the hell is using Uniswap at $1 billion volume per day? And the second is Pancake, because Pancakes use Pancake Swap, and Curve with 89 mil. Who the hell is using Uniswap? What is this? If it never even surfaces in the Llama, a meta aggregator, who's using it? So it gives you an insight into the demographic, the user base composition of who's using these systems. People are using Uniswap that have no idea what the fuck they're doing. And that's okay. You just need to know that. And that's why we've talked about Bunny of late, because that's a potential opportunity to capitalize on a very uncapitalized market. Very little profit potential with regard to Uniswap. And if Bunny can bootstrap a currency recycler onto $1 billion worth of volume, that'd be cool. But the problem is the liquidity. What is the liquidity composition on Uniswap? And clearly, the vast majority of the liquidity on Uniswap has no fucking clue of the significant infrastructure that has been built over the last couple of years. And Bunny, memes aside, and all the shit that people get hung up on, that get in the way of people finding opportunity, is not allowing them to see a currency recycler and compare it to the implementation. And Bunny is actually unique with its options emissions. It's unique. And come on, and I have an expectation that may not be coming to fruition. I would have expected to see significantly more liquidity flow over to Bunny because it's Uniswap. Bunny deposits to Uniswap. So people are just not putting two and two together, and that is what it is, which the use case isn't invalidated. My investment thesis isn't invalidated, but it's dampening the excitement I had for the potential it still does have. It's just not coming to fruition. But in any case, I've aligned my interest and I have a long-term lock, and whatever, it'll be what it's going to be. And I position sized accordingly. Curve, entrenched. Lower liquidity conditions, but the financing remains the functionality, and there is significant revenue on a weekly basis from various sources. And Frax is just coming out swinging with understanding you recycle your transaction fees. If they have protocol and liquidity and you're recycling your transaction fees, you're going to get more liquidity over time. And these numbers are trivial numbers now. It's trivial financing. But I find it interesting that they just plowed their transaction fees right back into vote market. I mean, look at this. 1, 2, 3, 4. I mean, they're just going to just recycle their transaction fees and use the currency recycling system for what it's meant to do. It's meant to pay people to deposit liquidity, and this financial recycling disrupts the circulating supply chain, and that's why we see exactly what we see here of basically horizontal price action. I had a where's my good chart? I wasn't looking at Coinbase. I was looking at a different chart that I like to look at historically. But you basically see horizontal. Yeah, here. And then on log. Nice horizontal price action year over year. And then if you look at Aura, it's basically horizontal. If you look at Lit, it's horizontal in legs because there's emissions and then there's buyers because the buyers want the financing. Complexity is these boys really need to get their financing up. You need to see the financing. That's why Velodrome is doing so well. But Velodrome is supported by the capital of OP, which is the same bullshit as ARB. There's nothing. Nobody gives a shit about governance. Oh my God, this whole thing, ridiculous, ridiculous. All right, I'll talk about LPing, but let's say hi. Dan's in the house. Good morning. James, Paul, Tapsy, Lucian, Ear End. Majority of people have to invest engaged that way. PVV capital gains focus to make it where they can sit back and collect yield bribes with a meaningful base position. In my opinion, it can't. Oh, of course not. I mean, during periods of exuberance, we'll be talking about capital gains. We'll be talking about player versus player. When there's a trend formation, you remember how we played Matic and we played Rook, and these structures will be there. We need to see large ascending triangles. I don't want to see support holding a support. I want to see resistance getting hammered 3 times and then a breakout. When there is an obvious opportunity for capital gains, there's no reason not to take advantage of it. The second people get into trouble is when they try and force something that is not necessarily easy. And this is a negative sum environment, concentration of capital from the inexperienced to the experienced, from the rabbit to the lion, predator prey analogy. And that's true. And if you want to take small sums of capital and turn it into large sums of capital, you can't lose capital. So you have to be prudent. And that means you have to wait. I would say wait to a period of exuberance. And that's why this period of time is so important. You know, this is like a late 2018, 2019 feel from a market vibe sentiment. There's doldrums, it's complacency in the market, but this is where you figure out your strategy, what you're doing, why you're doing it, how you're going to do it. And that's why I've been trying to talk about such a broad perspective in the last couple of streams of how do you get started. And you're right, Dan, but you got to be methodical. And you know, it's easy to say these words. It's hard to gain the experience to do it. Where do you start? I don't know. I don't have all the answers. I have the stories. One could look at Ethereum USDC LP with a decent range. We'll get to LPing, collecting yield up and down the range, sure. But then with a, we'll get to LPing. We'll get to LPing. But yes, I like the LPing. We'll talk about it. Lucian, what's your min position size for an asset? Depend on trying to control a certain percentage of the protocol. That plays into what I want to talk about with regard to LPing. Position size is critical. If you can't acquire a meaningful position size, it's invalidate the narrative. Fortunately, in terms of revenue, value assets that pay you, you can think in terms of cash flow cost averaging. Oh shit, I love that phrase. That's something we came up with probably in the last year. If you're getting paid 20%, 30%, you're getting a reasonable dividend. You're getting almost all of the cash flow of the protocol. You can think in terms of, I'm going to spend $1,000 and I'm going to get $50 a week. It's meaningful percent. You could translate that into APR, do whatever it takes for you to mentally wrap your head around it. But ultimately, the calculation is I want to buy weekly income, bi-weekly income, hard currency units. Not hard currency in terms of dollars, but these are hard synthetic currency units that I could use to put on a debit card to go to the supermarket. If you could click a claim button and put it on a debit card and go buy shit at the supermarket, that's awesome. That's what affects your life now, not necessarily into the future. Now is important. It's just as important as in the future. You prepare for both. Expectations. So that's my expectation. My expectation as being a 40-year-old family man is being able to pay my bills. That means I got to think in terms of ways that I'm actually making money. in a way that I could use. I could pay a bill using a damn debit card. That's why I talked with the wife on that stream a while back. And how do you spend it? You got to know how to spend it. There's no point in doing any of this shit if you don't know how to spend the money. I want to talk about LPing. I'll get to it, Dan. And Lucien, you talked about position size. Hey, Capisarco, it's key to emphasize that one's expectations. I have a good job, which I love, it pays me well, and egg sandwiches. Yo-ho-ho-ho. So it's rational for me to hold SFRX ETH BTC as if is it? So well, we all have to come to those conclusions. It could be rational. Um, you're going to want to sell them at some point. Frankly, SFRX ETH is really cool. That's liquid 10 to 11%. That's pretty cool because you could borrow against that. Uh, you could. That's a heck of a position because on Fraxland you could borrow against SFRX ETH. That's why I was talking to IPOR about getting, a swap for FRX ETH. Then if you could lock in like 6, 7, 8% with the interest rates hedged, that's crazy. Position size could potentially invalidate that uh, as something meaningful. Is it rational? Yes, but rational can also not be meeting your expectations. So if your expectation 5 years is, a 10, 15x on the money, it's probably reasonable. It's probably rational. But just remember, what if it's less? What if it's 5x on the money? Because it's a balance. That's an LP. Is 5x on the money going to turn $1,000 into $5,000 in 5 years? Is that meaningful? I'm not saying that's your position size, but you have to think in terms of position size. 500% is astronomical from like a QQQ or an SPX perspective. You're not getting 500% in that shit. But 500% is not as much as people think, unless your position size is according to your expectations. Listen, 500% on $1 million. Yeah, of course. $4 million profit in 5 years? Come on, all right, fine. So that's why part of the equation. But if you're playing with 1, 2, 3, 4, 5, 10, 15, 20, maybe even $50,000, 50,000 to $250,000 in 5 years, all right, that's cool. That's cool. That's cool. You know what I'm saying? That's cool. Not gonna buy a house. Not buying a house with $250,000 nowadays. So maybe that's your car thesis. Maybe, all right, I got 50 grand, 5 years time, gonna let this stuff simmer. It's gonna be wicked volatile, but in 5 years time, I'm gonna get that Urus. Hopefully a Urus is still $250,000 in 5 years. But maybe I'm gonna get that $100,000 car in 5 years. So maybe that's your car fund. So, but that's structural. Maybe you make an investment with an expectation for a particular thing. Car fund, house fund, you have short-term pay bills fund, what's going to pay you income. And then you have your ultra long term, 10-year, 20-year. Time horizon, position size, granularity of how you structure the portfolio, different investments for different things, have one ledger for one thing, one ledger for another thing, and break it down. Maybe you have one ledger, you literally put in like 5 Ziploc bags and you bury it in the backyard. Not saying I did that, maybe I did that. Based on my risk tolerance and position size, I can then take 1 to 2% bets when we get liquidity easy mode. Listen, everything you said is spot on. 1 to 2% bets, 1% to 10% changes everything. Changes everything when you can get 10x's on 1% of your portfolio and turn 1% to 10%. Changes the entire composition of the portfolio. Well said. I love how some of the stuff I said years ago still is overwhelmingly the case, and that 1% to 10% is a wonderful, wonderful thing. Do you think layer 0 AMMs will help the fluidity of the ecosystem? Yes. I think it's an unknown way it's going to play out because you're talking about L2 narrative and what's the significance of them. I don't see it right now. The future is exchanges on L2s. I just don't see it right now because you listen, if you got 100 mil or $1 billion and you're a bank, you don't give a crap about speed. Ethereum mainnet is ridiculously fast, and you don't care about transaction fees at all. If you're doing a $100 million transaction, would a bank care if it was a $5,000 transaction fee? What they care about is the finality and the flattening of the risk profile. And if you eliminate the entire L2, you've significantly altered the risk profile of the transaction. So that's why mainnet, to me, is where the big liquidity will be. That's where the big volume will be. That's where the big activity will be. So you can have fun with the LPs and the AMMs and the L2s. I don't know the significance in the overall structure in the coming years. But when I'm thinking of LPing, I'm actually predominantly thinking of the L2s. So, well, maybe let me get through the comments and I'll talk about the LPing. Lucian, my man, yeah, the rabbit. That's the deal. Hilda's in the house. I hope you're good. It's a pleasure. Brian, are you a fan of Trader Joe, Liquidity Bug versus Uniswap V3? Oh, you get to the LP that's catching my fancy, and that's Trader Joe, particularly in Arbitrum rather than Avalanche, albeit, you know, they originated in Avalanche, but Arbitrum's got the liquidity. It's the liquidity that catches my fancy. So let's go back real quick. Let's look at the liquidity conditions on Arbitrum. 1.24 and Arbitrum's got 2 bill. Significant change of liquidity condition on Arbitrum. You can have more financial opportunity on Arbitrum as compared to Avalanche. Uh, that's it. Period. When you could dig in and think about speculatively the way things play out, the way the liquidity conditions change into the future, but don't drive yourself nuts. Opportunity is where liquidity conditions are favorable. When opportunity is where capital is flowing to, and the system is filled with capital flowing everywhere. The liquidity composition of the overall system, not just crypto, into and out the world, different countries, is always flowing. So, and there's always capital flowing from shitty opportunities markets to outperforming markets. And right now, that's the Arbitrum. My story will change. If all of a sudden Avalanche had 5 bill, capital and opportunity are flowing back. And fortunately, Trader Joe's over there as well. Yeah. Listen, the license just expired for Uni V3. Trader Joe and their 2.1 and the auto compounding of fees and what they're talking about with regard to automatically adjusting bin allocation. This has overtones of what Curve does, what Curve excels at, what Curve owns with regard to the capacity to concentrate liquidity. The Curve algorithm is infinite liquidity at spot. That's the way it's designed. And that's why you know, Michael and folks they've done what they've done. Now the other protocols are trying to achieve something comparable in a way they understand, and Trader Joe has done that with their bins implementation, and they're obviously designing algorithms to adjust where the liquidity is and which bins, and that's interesting. Um, so let's talk LPs. LPing is interesting and a potentially meaningful opportunity, and also a potentially capital losing opportunity. Position size is critical. You can capitalize significantly if you own the vast majority of the LP. So if you're able to identify a relatively new asset and somehow you're able to acquire a good portion, 50, 60, 70% of the entire LP, if there's significant volume, it's going to be basically a little printer that could. Now, obviously, this is going to be very restricting depending on a personal portfolio size. Obviously, money makes money and the rich get richer is applicable to basically everything we do. So someone that's throwing around 1 million, 2 million could much more easily dominate an LP as compared to someone throwing around 5 grand or 1 grand for that matter. So you should easily invalidate this type of engagement with markets if it's not going to work. Now, my thesis with regard to deploying to LPing is that if I could own 50, 60, 70% of an LP, that's an opportunity. If I can't, I invalidate it. And there's few and far between. But in the L2s, it gets interesting compared to mainnet. What I find is that there's L2 opportunity where there's like small liquidity, but volume. Small liquidity and volume means you have a potential to come in with an adequate amount of liquidity to have a meaningful percent of the overall LP, which means you're getting the vast majority of the transaction fees. So that's why an opportunity can be there, but you need to show restraint because LPing, especially in a bullish environment, is losing money, and if the things are depreciating, you're losing money. So at the end of the day, I like to think of LPing as a daily operation. At the end of the day, I cash everything out, and if I have more stable coins that I'm transferring back to mainnet, great. There's your profit. You did well. And that's how you're able to assess how you're doing on a daily basis. Exit. Clear the books. Clean slate. Don't sleep on this shit. I don't know. I don't know how people have the stomach, manage the anxiety to sleep on these volatile assets overnight. I can't do it. I can't hold spot shit overnight. It's ridiculous. That's why they talk about voter escrow and lock positions as like the holy grail of investments. I can't handle those emotions. So that's why we've been talking about this shit the last 4 years, because I had to think of ways to to engage with these markets that are so emotional and I made it simpler. I made it much simpler the way I do things. And I easily invalidate things that I can't do. I still get very disappointed when I can't do something, but I didn't do it, which means I don't have an overnight risk or I don't have an increasing chance of losing capital. I'm protecting capital, and that's how we've gotten to where we've gotten to. I don't know what Apex is paying dividends, Marvin. Dividends isn't just paying. What's the source? What's the sustainability? And the only true sustainable cash flow is transaction fees. GMX has done well. It's a very heavily vested interest position. I mean, it's Arthur Hayes. He basically owns it. And then there's very large actors that are there. So there's a fair amount of due diligence in allocating to something that has such activity and such vested interest. Like, what happens when someone with 10% of all liquidity sells? They're going to nuke the price. Can you handle the volatility? So I can't handle shit like that. Oh, dude, mention Blizz. Oh dear Lord. Think about Ave. Ave, I'm not interested in the money markets. I'm just not. I have zero interest in the money markets. I have interest in Eurodollar markets. I have interest in those types of transaction fees, debt servicing payments, cross chain capital flows, those types of transaction fees. That's why Stargate's interesting. That's why Layer Zero, obviously, as a messaging protocol, is interesting. That's why multi-chain was interesting, but look, it turned out to not be very cash flow meaningful. If you look at the amount of capital is required to spend to purchase your weekly revenue, it's not effective. You would need an enormous amount of capital to make 5%. $1 million gets you 50 grand a year. There's your calculation. It's a cash flow cost average, which means allocating to that is opportunity cost. Tapioca's coming. That should be interesting. It's all speculative beforehand, but I think that that's an interesting one using layer zero and cross-chain liquidity, seamless synthetic currency unit transference cross-chain and collateral transferring cross chain, or the capacity to borrow against collateral cross chain is very interesting. And I look forward to its final mainnet deployment, to seeing what kind of activity it gets. We'll see. Last questions and we'll wrap it up. 33 people in the stream remaining. 13 likes. Hit that likes button. I appreciate it. Do you like how the new LBR with the concentrated liquidity? Man, I've been following your work for years. I've built my portfolio based around a lot of the concepts. You break it down. You're very welcome, my friend. LB as a liquidity book. Trader Joe, yeah. I look forward to 2.1. It'll make it even easier. The concentrated liquidity is great. Mainnet, the problem is you can't rebalance. It's too expensive. You're going to eat into your profits really quickly. With the L2s, a couple buck transaction fees, depending on position size, you can rebalance once every 10 minutes if there's enough volume warranting the rebalancing, and that makes a big difference in potential revenues. So yeah, Trader Joe is very interesting how much they're iterating at what they're building. Um, what else on L2s, AMMs? I wish Kyber did better. Kyber's been around. That was how we did our start in late 2019. Kyber was off to the races next to Bancor back then. But what else on the L2s? I don't know. Uh, what, the solidly forks? Listen, if you're looking at any of the solidly forks, just a thought. It's all about the third party financing. And that's what some of them are forgetting. You're not going to compete with regard to transaction fees as revenue, because transaction fees are a race to zero. It's all about volume. So you need basically zero transaction fees to get the volume. So third party financing of the recyclers is absolutely critical to maintain. Oop, no, not that one. 65 cents on solidly mainnet. All right. I'm not here to say. I'm here to say good things. Look for look for capital financing, and that's what sustains the currency recycler implementations. And mainnet is crowded. Curve dominates. That's how you finance a new protocol. That's how you finance a protocol. Frax has figured that out. And or a balancer that has somehow carved out a liquidity financing regime, probably because they innovated their way in. The 80/20 VE positions that they launched and are also offering grants for other protocols to launch, that's how they carve their way into a currency recycler on mainnet. They do like no volume compared to the competition, but they're able to finance liquidity very well. And the volume there and the TVL there is meaningful. Let's look at the volume real quick. The balance is way down on the list. Where the heck is Balancer? Balancer, number 8. I mean, it's not way down on the list, but you're talking $32 million a day compared to Uniswap's $1 billion a day. Trader Joe's hitting 68 mil a day. So, it's there. And that's meaningful. And the fact that it's doing what it's doing is why we've taken attention, where we're paying attention to it, because it's an effective currency recycler implementation that's paying out very nicely on the biweekly basis. That's because third-party financing has figured out how to recycle the currency output into input, and that creates the flow, the capital flow, and capital flow attracts opportunity, attracts attention, attracts engagement, and gets people doing stuff with the protocol. That's pretty cool. LPing, liquidity providing. What do you think of LUSD as an alternative to USDC, USDT? LUSD is a big deal. Liquidity is a big deal. I like it. I don't have investment interest in it. I have interest in providing liquidity for it. That you have to rewind to see what I talk about with regard to LPing. But it's interesting. I like liquidity. It's meaningful. It's immutable. It's a big deal. Um, I'm going backwards in questions. Have been LPing stable volatile pairs while hedging the volatility part with lending markets. Biggest loss so far from the USD peg. Didn't expect that one. Watch the losses. LPing is high risk. You lose capital. So, at the end of the day, close it out. Close out the books. Start to think of why, what caused the capital loss, what caused the capital loss. And we could all do better. Learn from mistakes. AI tokens, the new wave. No interest from me. Any thoughts on Pendle? Nothing from me. Thank you all for joining me. Monday, April 3rd, 12:35 p.m. You know the deal. Tell everyone to subscribe because I'll help you guys do more rational things in one of the most irrational markets on the planet. You know the deal. After party on Discord for the most rational community in the entire crypto space. I wish you all a good day. I will catch you guys later this week.